Hello and good afternoon to everybody here. We're going to give everybody just a couple more minutes to settle in before we get started, and then we'll take it away right at 1 o'clock. All right, so welcome everybody to this Payments Journal webinar sponsored by Factious titled Payments in COVID-19, How Transaction Data is Leading the Way Through the Pandemic and Beyond. I'm your host, Ryan Mack, and I hope everyone that's with us today is safe and healthy. Now, a few housekeeping items before we begin today's webinar. First, we will be having a Q&A session at the end of this webinar, and I encourage you to ask any questions that you may have by simply looking at the toolbar within this application, clicking the questions drop down and typing your question and then clicking submit. We'll certainly do our best to try to address all the questions that were submitted to us, but if we're not able to have time, we will follow up with you via email. Now, next, we will be making this presentation recording available after the webinar. So now for our guest speakers today. We have Tim Sloane, who is the VP of Payments Innovation and the Director of the Emerging Technologies Advisory Service at Mercator's Emerging Technologies Service. And he focuses on the business impacts of those new technologies and their potentials for issuers, merchants, card networks, acquirers, and vendors competing on this tech-driven landscape. And also we've got Randy Cook, who is a successful technology and data executive with the experience in leading startup and multinational companies. As a CEO, Randy has led Factious's growth to successfully monetize data for more than 1,000 plus financial institutions by leveraging Factious's innovative synthetic data platform. Randy is widely considered a data thought leader, authoring Data Monetization Roadmap, which is the standard methodology for securing and monetizing data. So without any further delay, Tim and Randy, you have the stage.
Thank you, Ryan. And thank you, Randy, for being here. You've certainly helped keep me informed as to how we can actually manage data and get it available in ways that protect the privacy of the users and meet the regulatory requirements. The themes for today, we're going to be taking a look at how COVID-19 has fundamentally changed the consumer economy and therefore changes what we have to do to understand what's going on and how to forecast into the future. We all know and we read frequently about greater use of online e-commerce, mobile devices, shopping behaviors that are totally different. And we'll dive into what that means and how one has to approach it. We'll look at payment transactional data as the mechanism for being able to track those changes in something very, very close to real time to understand how the pandemic is hitting consumers and how they're reacting to it, and how that is capable of being presented, how that basically highly confidential payment transactional data can be made available in a way that's safe and protects the individual's privacy, protects the financial institution and everybody else involved to make sure that the data is clean and capable of being leveraged. We'll highlight or not. Can we go to the next slide, please? I'm going to assume we're on the next slide. So this slide identifies the types of data that has been traditionally used to understand what's going on in the market. On the left, we can see that the Fed's monitoring of GDP is done quarterly. And given the way we're using big data nowadays, it's kind of quaint to see it. On the right side is the more real-time evaluation of the panic created by COVID. But obviously, it isn't measuring consumer behavior. It's measuring investor behavior, which isn't going to help merchants or businesses better understand what's going on with the consumer and how they should be interacting and reacting to the consumer's behavior. Next slide. So the US Census Bureau also is producing data, and they're doing a better job. They're only a month behind. This is a monthly sales, and it's delayed by about a month. But the reporting granularity sure leaves a lot to be desired. Retail and food services is, after all, an extremely large swath of the overall market and territory. It's too large to help identify impact on, say, fast foods versus restaurants. And so if you're a decision maker trying to figure out how you should react in COVID with a chain of restaurants in multiple states, this really just isn't going to cut it. Then you have the Bureau of Economic Analysis on the right-hand side. They're able to provide data at the end of May for what happened a month ago and details personal income and expenditures, but it also lacks granularity and is often updated several months later based on newer data that they receive after the fact. Now, to be fair, these are major data collection efforts, and so we should be happy to have them. But in the world of COVID, this is simply insufficient to be able to help us react and understand what our next steps should be, given the behavioral shift that took place almost literally overnight. So let's go to the next slide. Opportunity Insights is a spin-off. It's kind of operated by Harvard, consists with Brown University. It's been supported by the Bill and Melinda Gates Foundation. And this is a quote that came in their press release. The fact that in this time of such fast change, being able to collect data from individual businesses is really critical, and it needs to be done in real time to be able to make an impact on the analysis. And when you get it that way, it has a major impact on economic research and the analysis that can really help guide the public and guide policy. But in our case, we want to make that even more narrow and identify how data can be collected and leveraged in order to guide specific businesses. And with that, let me pass it over to Randy to talk a little bit about Factious and how they operate and the data that they have that can help that. Randy?
Thanks, Tim. And thanks to Mercator and Payments Journal for collaborating with us on this webinar. Before we get into the data, and specifically the data within the COVID era, I want to provide a little bit of background on how Factious fits into the payments ecosystem. So Factious is a data company, and we're focused on delivering insights on financial data while protecting privacy of both the consumer and the financial institution. And we do this with a two-part business model. The first is we provide analytics to over 6,000 plus financial institutions on a daily basis. We do so on a white label basis. And secondly, and more importantly for today's discussion, is we help payment companies and financial institutions monetize their data. And more specifically, what we do is we take about 50 million daily transactions. We ingest those from our financial partners. We aggregate those, take out all the PII, and then we monetize and sell those data insights to various verticals and industries. Examples of clients of ours include the Federal Reserve Bank of the United States, who buys our data products. FIS and other large processors are partners of ours. We sell to large investment institutions like mutual funds, hedge funds, pension funds that help give them insights so they can make better investment decisions. And lastly, we provide our data to various large academic institutions so they can provide research from their large amounts of other data as well. Before we actually get into some of the data insights, I really wanted the audience to focus on 3 key themes as we go through these data trends that we're seeing during COVID. The first is the value of payments and financial data. Payments data and financial data is by far the most valuable data in the US economy, and it's not even close. The second thing I want you to focus it on is there's been a shift in the way the economy, and quite frankly, the world thinks about sharing data. In the past, sharing data was somewhat seen as scary, but that is no longer the case during the COVID era and hopefully beyond. We'll show you a safe way on how to actually share this data in a way that protects your consumers and your banking institution. And the last thing, as we go through some of these trends, I'd like you to focus on 3 dimensions that Tim and I will talk about. And those dimensions are accuracy, timing, and decision making. And what you'll see in the COVID era and what you see in data in general is we need data that is faster and more accurate than it's been in the past. We can't make decisions for your companies. You know the right decisions to make. However, you will make far better decisions if you have timely data and accurate data in front of you than you will if you have data that's lagged months and sometimes quarters. So given that, let's transition into 6 trends and data inflection points that we've seen over the last 3 months with COVID. The first here is a trend we've seen between e-commerce and in-store spending. And let me back up and tell you where we get this data from. This data here is taken from, again, approximately 50 million daily debit card transactions from 1,000 plus banking institutions. And what you see here, and what I want you to focus on here, is there's what's obvious and there's what's not obvious. And what I think we all knew was obvious is that e-commerce was going to grow during the COVID era. However, what we didn't know was the inflection points. And a couple inflection points that I'd like to point out here are, if you look at approximately the beginning of March, you start to see a rise in e-commerce. And as we peeled back the data, that was driven by 2 things. One, the beginning of COVID was just getting started and the awareness of it. But also added on top of that was a large influx of tax refunds hitting the consumer sector and therefore the ability to spend more. And then what you see after that is a decline from March 15th to the end of March. And that's the decline from just that tax refund money coming out of the system. And then you see this dramatic increase of e-commerce spending going all the way up to 117% of year-over-year spend, which is just a mammoth increase. And the thing I want people to think about here is what that is all about is inflection points and timing. So over time, and as Tim pointed out, the key questions become, when does that level out? And to what extent? Does it go back down to 25% growth, or does it level off at 50% growth? And the more data we have on this and the more timely it is, the better decisions we can make.
And I have to say, being able to see funds being put into the accounts certainly gives you advanced warning as to what kind of spend can take place. So both sides of that are important, both funding as well as spend, which you've got access to.
I couldn't agree more, Tim. And I think for this audience, the other thing that we have to think about is what is the better decisions that could be made if you're a merchant, a payment processor, a banking institution, or any payments company, if you actually knew the day of or the day after those inflection points and what the true number was. It's very obvious that we'll be able to make better decisions if we actually know those real numbers and know when they're happening.
Yeah, I like the juxtaposition of the previous slide and this slide. Knowing they're doing additional spend is one thing. Understanding who it is and where is another thing.
Yeah, you're exactly right. So this slide basically represents the change of behavior of different generations. And what we did here is we took Walmart online shoppers and broke them out by all the generations. And while this slide isn't as dramatic as the last one, I still find it fascinating. And if you really hone in on the boomers themselves, who in the past have been very slow to adopt an online shopping, they basically didn't have a choice during COVID. And so what you see is a large increase. 8% doesn't seem big, but in real dollars, that's hundreds of millions of dollars going into e-commerce, which is just a mammoth amount. And it leads into a couple questions, which is what happens next? And specifically, does it go down from there all the way back down to 23%? Or does it level off around 25%? And knowing the answer to this, or at least knowing which way the trend is going, is incredibly important and valuable to the payments ecosystem.
And I'll add to that this raises questions that an online merchant probably should ask themselves around those boomers that are now climbing into e-commerce. I would go back and start validating my website and my checkout screens to find out whether I've been losing any of the boomers as they've come into my site because they're new and maybe are unfamiliar with the way it operates. And that millennial dip, I'd want to know if that has to do with my fraud controls not being tuned to recognize people are going to start shopping at 2 in the morning now instead of shopping at 8 o'clock or noon during the day. It could be I'm turning them down.
Yeah, and Tim, you're exactly correct. That's the whole point of why data has to guide the way here, because the questions you're raising and the decision making of payments companies, those questions aren't as apparent as you just mentioned if we don't have this data in real time. Let's take a look at the next trend. So in these two graphs, what we tried to show you was some mammoth growth and to highlight some of the questions or decision making around exponential growth. In the first one, we take Instacart. And you can see Instacart here year over year went from basically double its growth, 100%, up to about 700%, essentially, within weeks. And that leads to a question, really, well, it leads to a lot of questions, but for Instacart, what's going to happen as we come out of COVID? Does this settle back down to 150%? Grocers who are depending on this now, what happens once COVID ends and Instacart is not one of the main channels of delivery? How is this different between any given generation? So we're very interested to see that inflection point and once that happens, because then it leads to a whole bunch of different questions and decision making that need to happen. The other chart here is on consumer video spend. I think it was pretty intuitive that video spend was going to go up somewhat, but what's interesting is video spend just won't stop. I mean, this growth is just continuing to go month over month, week over week. And it also leads into some interesting macro and payments questions, which is what categories is this mammoth growth stealing from? So, for example, will people buy less movies? They'll probably still stream them, but will they go to the theater less? And again, after COVID tops out, does video games go back to a more modest growth, or does it stay at this very high level amount of spending?
Yeah, again, it just keeps raising interesting questions as you see the real data. You imagine that a company like Starbucks would love to know not just Instacart, but Grubhub and Uber Eats and the rest, and how they're covered across a geography, whether any of them have kind of cornered a market segment. The data just brings out more and more questions that could help companies react and decide who they should partner with and how they should execute in this COVID time.
Couldn't agree more. And as a follow-up, that's a good segue, Tim. This next one juxtaposes restaurants versus fast food restaurants. And you can see, right when COVID is hitting its height, right after mid-March, they both just nosedive down to an incredible decline in growth. However, as you can see here, and probably what your eyes have told you, is that fast food recovered pretty quickly. And quite frankly, right now, they're above year-over-year growth. However, restaurants, which are a huge segment of our U.S. economy, are still struggling. And while they are increasing, as the data shows, what I'm interested to know is, does it ever get back to its pre-COVID era? And if so, what does that look like? And what are the impacts to payments companies? Tim, you mentioned a use case that we've seen before, which is right when COVID happened, the data showed that takeout and drive-through were obviously the new modes of transacting with fast food. And so we saw a lot of merchants come to us and simply ask us data about, what geographies, what zip codes had the most takeout or delivery, and then put in new locations at those zip codes where they were seeing a lot of success for drive-through and takeout. Data helps drive those decisions so that the restaurants can recover in a more quick manner.
Absolutely, and not to mention react. Which restaurant, if I've got multiple restaurants across multiple geographies, which ones am I going to close? Which ones am I going to keep open? Who should I partner with, Grubhub or others, in order to make sure that I can keep those restaurants somewhat profitable during this downturn and until people can come back and eat within my stores? Just a fascinating list of data that can be applied to a wide range of business questions.
This next slide, I think we could talk about for hours, but I find that's just fascinating. And so what we tried to do here was, look, we've analyzed the spend categories, we've looked at it across various generations and age groups, and then we decided to take a slice of it based upon geography, which is a very important discussion going on right now as to when we reopen the economies. And obviously, there's a balance here between health factors and spend factors. And what we see as Factious as our job is just to provide very accurate data on the spending habits of cities, states, and the overall nation. And what you see here is essentially three states, South Carolina, Tennessee, and California. And the fourth one is the overall US. And what you see that just jumps off the graph is that South Carolina opened very early or reopened early, and their growth has been very dramatic. But what's also interesting is the inflection points. You'll see in the late April period where it just levels off and then it spikes back up again. And after you look at that, the spending categories, what you see is they simply opened up more of the economy. You see a more steady growth coming out of Tennessee once they opened. And then lastly, you see that California still has its doors closed, and they are well below, at least it shows 50% below than where they were in the pre-COVID days. And this data is obviously very helpful for those who set policy on when to reopen states, or even like within Florida, they opened up the rest of the state, but they left Broward, Dade, and Palm Beach counties closed for 3 weeks that lag. So this data, this payments data and spending data, is very valuable to those that are setting policy.
Yeah, I'd love to see this with the COVID rate on top of it, hospitalizations as an example. You'd probably see a lag, but see a correspondence to it. And you wish there were more looking at this data to really tie together the impact of opening or closing and COVID rates and spend. It's great chart.
Yeah, you're exactly right, Tim. And another thing that we noticed within this chart is where we noted the stimulus run up. So obviously we know when stimulus was injected into the economy, that put more money into the hands of the consumers. So it's very important from an inflection standpoint to know when does that stimulus run out, and then when does the economy recover again. So that's why you see an immediate dip right after essentially April 18th.
Yeah. And gone.
Next slide. So we've talked a bit about how important timing is and accuracy is in order to help the economy and the payments ecosystem during the COVID era. What I've done here is we've taken very current data. So again, 50 million debit cards from 1,000 plus institutions. And you can actually see this on our website. So if you go to Factious.com, you'll see what's called our first reports. And we provide a daily U.S. consumer spend chart that is lagged 1 day. So if you want to get real consumer insights that are very accurate, feel free to go to this website and track the overall U.S. daily consumer spend. But what I really wanted to point out here was what happened 2 days ago, which is you can see the ebbs and flows of the consumer economy here. And 2 days ago, it looked like we were headed for another deep dip. And so not only is Factious, but a lot of economists looking around to see if this was going to dip again down to its 3% or 4% level. It was a very nervous time for a large part of the economy, but then it leveled off and started growing again. And if you think about this is just macro daily spend. But then again, if you broke this down into categories that we've seen before, whether it's airlines versus restaurant versus video, or you broke it down by millennials or geography, you can now completely understand how important real data is in real time to make decisions to get the economy going again. And then let me juxtapose that with what Tim said. And if you think about why payments data is so valuable to the overall economy, Tim pointed out the facts that are going on now, which is the data that's out there that's going into the U.S. Commerce Department or the Census Department or the Economic Department. All that is essentially lagged somewhere between 25 and 40 days. Furthermore, that data is usually done by surveys. So you can imagine all the inaccuracy and, quite frankly, the delay that's in that system just by doing surveys. And there's also a lot of bias because some institutions just don't respond to surveys. So that's why you can juxtapose the current system of providing data, which is usually surveys to large governments, to now understanding payments data in real time that's not only accurate, but we can provide it within a day or two of when it happened. And that's a mammoth shift of COVID, and it's going to be a mammoth help to the overall economy.
Operating in real time helps.
So up until now, we've talked a lot about some of the trends that we've seen out there, how we aggregate the data, how we monetize the data to various verticals. We've also seen a move to sharing data, what I'll call sharing data for good. In other words, to help economic policy, to help charities, to help fiscal policy. And there's two specific examples I want to show you here. The first is a consortium that a good partner of ours put together called SafeGraph. And basically, they took 15 different data sets. Organizations like Factious donate our data. SafeGraph does foot traffic data. Think about cell phone data. And create a consortium of 14 data sets that provide our data for free to academic and government institutions so that they can set economic and fiscal policy. So the idea there was COVID is obviously a very new pandemic to all of us, and we wanted the government agencies and the academic institutions to have great and real-time data to set better policy. Another good example here is what Factious put together when we analyzed the difference between low income and middle income spend. And this was actually a little bit counterintuitive for us because you can see here that the year-over-year growth was actually higher for low income earners than it was for middle income earners, which again is a little counterintuitive. But as we peeled back the data, what became obvious is it came down to discretionary spending. And more specifically, low income earners, they simply got to pay the bills, right? They have to go to the grocery store. They have to pay their cell phone bills. So as such, the percentage of what they earn to what they spend remains pretty consistent, whereas middle income and upper income individuals were able to save and not spend that discretionary income.
Let me take this one. So in talking to financial institutions, I'll say that many of them have already been thinking about how they can leverage the data that they have. They recognize the value of the data. They are being pushed in a lot of different ways on revenue. And so looking at that data as a potential form of revenue generation strikes a lot of the product managers as a good thing to consider. But looking at that bullet, compliance department says no. Almost everyone I've talked to indicates that that's the first answer from the compliance department. You know, compliance needs to deal with the data privacy regulations, interact with the regulators directly, and simply believe in their heart and soul that data cannot be released from the financial institution. However, there have been several instances, and I think Factious and the growth of Factious is proof of this, have found that indeed there are ways to release that data. You can safely monetize the data if you educate compliance, legal, and security around the process that's going to be executed on the data to maintain its privacy. And to a large part, that's tied to this new capability called synthetic data. And it enables you to maintain a statistically valid set of data elements that can be analyzed and come up with the same result, even though the data has been, if you will, made safe and the exact data has been modified. Let's go to the next slide.
So Tim, that's exactly right. So I think the best way to describe how to better leverage data and better monetize data is to really understand that there are actually three different types of data. And payments institutions and financial institutions should deal with all three types. So let me describe those. Companies like Factious, we deal with all three of these, and so do our payments partners. So the first is raw data. And that's pretty clear, right? That's obviously all the PII, the exact transaction, the exact amount. And obviously the risk profile of raw data is very high, and you want to be very careful with that. In the case with Factious, the only time we will work with raw data is when we're doing fraud analytics for our customers. Anything outside of that, we don't need the personal information. We don't want the personal information. We don't want the higher risk profile. But when we do get it, we obviously have a lot more controls around security compliance and regulatory controls for the raw data. The second group, which was the most prominent group about 2 or 3 years ago, was anonymizing the data. And that's pretty straightforward. I think most people understand this. Is basically you just delete all the PII, but you keep the transaction amount the same. You keep the merchant location the same, etc. So basically, you just remove the PII. The big shift over the last 2 years has been in synthetic data. And synthetic data, essentially, if you define it in one sentence, it's fake data. And so what we do to further remove the individual and the banking institution from the equation is we actually inject noise and create fake data off of the anonymized data. So for example, we'll change the transaction amount by 1 or 2% up or down at any given time. We'll change the location, and instead of a date of birth of the individual, we'll assign them to a generation. And as you can see here, there is no risk when creating synthetic data. You are just far removed for the individual and far removed from the banking institution when you aggregate all the synthetic data transactions and provide that in a 50 million card panel. And now you're able to provide this data very safe and securely to industry.
What's great about that is it also prevents correlation. The anonymous data, you still have actual data that could be used against another data set to correlate it back to the individual, back to name and address, and that's been done. So that ability to create synthetic data enables you to prevent that kind of correlation from being done, which is very, very important.
That's right, Tim. And a good example of that we saw was if you take anonymized data and if you combine that with other data sources, for example, cell phone location, it is possible to reverse engineer back to who the individual was.
Exactly. So here we're looking at a wheel that helps us understand where data can be used, and basically internally and externally. And so looking at some of the internal monetization examples, and this is by far and away not a complete representation of all the different places. You've already heard me commenting on several of the slides Randy had about, yeah, that makes me wonder. And there are plenty of additional ways to use this data. But internal monetization for a financial institution might include card performance benchmarking, branch ATM location selection, understanding credit line loan amount and duration. And in this world of COVID, maybe starting to understand, if you are in collections, which individuals you should be approaching fairly aggressively and which ones maybe are most likely to be capable of paying off in the near future. Identify and validate key life indicators, cross-sell. There's a number of ways this data can be used when financial institution understand where they sit and how they might want to adjust their business. But then there's the external monetization examples on the right-hand side. We talked about a number of those relative to merchants, but within a financial institution, there are opportunities as well to aggregate transactional data, understand location and value out of branches or ATMs, aggregated demographic data to help you understand who your customers are compared to others, institutions in the area. Understand open banking and what data can be shared through APIs and how others are doing that. Risk benchmarking, work with investment firms looking for transaction signals. So they're coming at the marketplace. And it's just a matter of imagination and need coming together to say, wait, we can answer those questions. This was an effort to try to get some thoughts going, but by far and away, the market and opportunity to leverage this data is much broader and much deeper. So Randy.
Yeah, that's right, Tim.
Good.
Yeah, and we'll share a couple examples of the external monetization of this. Here you'll see synthetic data, two synthetic data examples. The first on the left is simply aggregating all of the debit cards and consumer spend that we have and aggregating it by categories and showing the day over day and week over week growth of all the various sectors. Very important for the economy, very important for those who are studying fiscal policy to understand these trends, and quite frankly, very important to all those in the payments ecosystem to understand where the growth's happening and where we're declining. Another good example is for those entities that want to understand competitive behavior. This is a great example of comparing Home Depot versus Lowe's, and you'll see here that over the last couple of weeks, the incremental market share of Lowe's has just skyrocketed versus Home Depot. And this allows, merchants, retailers to better understand how they're doing versus their competition. And as we pointed out before, to understand consumer behavior, what's driving this? Is it a certain location? Was Lowe's, and I'm making this up, was Lowe's more heavily located in South Carolina and Tennessee than Home Depot? Or maybe it's a generational shift. Those are all questions and all decisions that payments data can help us out with.
Yeah, that's a fascinating chart. And again, generates a whole range of additional questions for both Home Depot and Lowe's. So, I think there is a strong case for financial institutions to go back and rethink how they can use data, not only within their own institution, that is, can I better share the data that I have with other departments within my financial institution, but also externally to consume data and create that source of truth for consumer governments and the like. Incorporate these into your business and investment strategies. There's the ability to release that data in a safe and sound fashion and generate revenue from it and improve businesses in the process. And it makes it very valuable and very real.
Yeah, Tim, and I'd follow up with that with, the title of this was the impact of COVID, and one of the big impacts that we've seen is just in general, there's been a shift of the consumer behavior of willingness to share data. And a good example is if you look at cell phone data, a year ago, that was seen as very scary to share that data. And literally a month didn't go by without an article in the Wall Street Journal or New York Times about how scary it was that cell phone data was getting shared. Now, during COVID, that's no longer the case. Foot traffic and cell phone data is getting shared all over the place right now, and it's seen as very helpful for helping solve and helping us get out of both the health risks and the spending data during the COVID economy. So you've just seen a massive shift of consumer behavior and the willingness to share data, and we should see that even more so on the payment side. And we have all the mechanisms to ensure that the data is secure and can be aggregated to protect both the financial institution and the individual themselves.
And I think that's the key, Randy. The financial institutions are going to need the support of companies like Factious to be able to not just anonymize, but to really make that data incapable of being used in nefarious ways. And the cell phone data, I think, is more difficult to do that with because its value is almost intrinsically tied to the individual that's holding that phone. Whereas the payment data is not quite so tightly linked. It's capable of being decoupled and made useful for other research purposes. This has been a lot of fun. Hey, Ryan, have we had any questions?
Yes, so thank you, Randy and Tim. Certainly really appreciate going really deep into that. Randy, kind of my first question is directed at you. We really talked about synthesizing data here, but I'd really like it if perhaps maybe you could kind of go over that in a little bit more detail, because I really think that that's kind of the magic sauce here, really, that kind of makes all of this data to monetization actually really work. So perhaps maybe we could go a little bit more into detail around synthesizing data and how that's done.
Yeah, no, be happy to. And it would be great if you can go back to that chart that showed the 3 data types. So the best way to think about synthetic data is a clear example here. So let's say, in this case, Tim Sloane. Let's look at the chart. John Smith, let's say he goes into a coffee shop, eats coffee. You have all the personal information about John Smith, and you have all the transactional information about John Smith. Now, the key thing about synthetic data is 2 major things happen. The first is we not only anonymize all the personal information, but we then assign it to groups. So for example, instead of a date of birth, we'll move that over to baby boomer. But then more importantly, on the transactional side, we inject noise, which is basically random algorithms. And those random algorithms change the transaction price up by 1% and then down by 2%. So over the 200 million transactions or 1 million transactions, the amount and the accuracy is still 99.9% accurate with the algorithms, but all the data is now fake. And the other key thing about synthetic data is, and this is a very major part of this, is we install the synthetic data app behind the bank's firewalls or the payments institution's firewalls. And that's a major advantage for a couple reasons. The first is that obviously all of the raw transactional data goes right from the institution into the synthetic data app, which is still inside their firewalls. And then only the synthetic data leaves their firewalls. So that's why it's so safe and so secure, is that the financial institution or payments company is not sending out any real data whatsoever. And the 2 main benefits of that are, one, that if you look at all the compliance regulatory issues, it's all about what you're sending outside your firewalls. And since only fake data is being sent, synthetic data lot of synthetic data falls outside of most of the regulatory and compliance obligations of the institutions. And the second part of sending fake data or sending synthetic data outside of your firewalls is that it can never be traced back to the bank or back to the financial institution. So that's how we would summarize synthetic data.
Excellent. Yeah, thank you so much for going a little bit more into depth on that. Now, obviously, we're talking about the monetization part of it here, right? So, I mean, I'm not sure how much of this it is that you can divulge on this webinar here, but what kind of revenue could actually be derived from monetizing your data? And if we're able to give that out, what do those opportunities really look like?
Yeah, so the opportunity, so let me answer the question. With our data partners, you know, depending on the amount of data and how rich the data is, you know, some of our data partners get anywhere between $1 million a year up to $40 million a year. So it's significant revenue, but as importantly, that revenue is 100% margin. So in the case of Factious, for example, we do all the investment, and the given financial institution basically just gets back their revenue check, which to them is, you know, again, almost 100% margin. And just a couple of use cases on how it's used. You know, look, the Federal Reserve Bank of the United States wants to know the aggregate data of debit card spending by age groups. They'll buy that data, and they do buy that data. They buy it directly from us. And so again, we synthesize it all, we aggregate it up, and we sell it to the federal government. We sell it to academic institutions. We sell it to consultants. But again, it's all synthetic data, very safe. And, you know, and I would say this back to the payments ecosystem. Look, not only is it good for you and your customers to better understand your data, this is helping the economy get going again and helping get people back to work. So, you know, there's obviously a capitalistic reason to do this, but also a very much being able to help the U.S. economy get out of, you know, this pandemic. And the last thing I'll say is, you know, look, at the end of the day, if fiscal policy is being set by whoever it's being set by, whether it's the U.S. Commerce Department, whether it's, you know, state governments or governors making these decisions, we should all want them using data, right? We don't want them guessing, or we don't want them using their politics. So just another reason why sharing aggregated synthetic data is good for your institution and, quite frankly, good for the overall economy.
Yeah, well said.
Yeah, I certainly agree. And thank you for that. Now, the next question is that taking a look at the data, the data points that you had mentioned there, that's overall spend, correct? And then also, is there a breakdown of debit versus credit card purchases that you have access to?
Yeah, good question. So the answer is what we showed was 90% debit card and approximately 10% credit card spend. And the reason we weighted it with debit is for two reasons. One, that's where most of our institutions have the most cards, and we felt like, you know, middle America and lower income America has more debit cards than credit cards, and that's where the bigger growth is. But I would say this to any of the financial institutions out there: look, if you have credit card credit card spend, if you have, you know, a large amount of B2B transactions as well, you know, Factious would be happy to work with you, and so would, you know, all of my clients would love to have visibility into that data.
Excellent. All right. So the next question that I've got here is around that same vein, right? So is there data on the digital payment usage and what the trend is among different generations? So i.e. tap and pay, mobile wallet, and other apps?
The answer is yes. A lot of that depends on which financial institution we work with. So if you can imagine working with 1,000+ institutions and getting a lot of different feeds, some do have that. I mean, there's very specific fields. So for example, if you think about a given transaction, it would say card not present or online or phone. But now we're also seeing some of the more advanced partners of ours also have another field that will describe, chip versus contactless, et cetera. So so the answer is yes, we have it. But I would say as far as how often it's populated, definitely when it gets down to the granularity of contactless versus chip, that is somewhere around 20% of the transactions that actually have that captured, but still relevant enough that we can capture trends.
I'll say we've been doing some research around that topic, and it's amazing how many of the merchants and the acquirers actually don't have that data either. They're only just starting to figure out it's important to capture.
Excellent. All right. So I think that that's all the questions that we have, but I do want to remind our audience of a couple of things. One, the recording of this webinar is going to be made available after we conclude today. And also, if you're looking for additional data points, Factious has been kind enough to allow us to be able to publish what they call their first reports on paymentsjournal.com. And if you head over to our COVID-19 coverage there, you'll be able to actually download all those reports. I think that Factious publishes those on a weekly basis. So certainly feel free to check back into Payments Journal early and often for those reports. And they've also been kind enough to be able to share with us in terms of merchant verticals. So we've got a bunch of daily charts up there as well too. So certainly feel free to go ahead and take a look at that. So unfortunately, that's all the time that we have today. And if we were not able to get to your question, we will certainly respond to you via email for that. So Tim and Randy, thank you so much for your time and all the information that you shared with us today.
Thank you, Randy. Thank you, Ryan.
Thanks, Ryan. Thanks, Tim.
Right.
Bye now.
Now this concludes our webinar. Thank you.